Market expectations grow for a 50 basis point cut by the Fed. They're now up to 50% as the debate grows over whether the US jobs market is too weak for just 25 basis points. And the yen hits its strongest level against the US dollar since mid-2023. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ's Chief Economist for Greater China, Raymond Yeung, sees the potential for China to unveil a 2 trillion yuan stimulus package to boost GDP growth this year, back up to 5%, and take advantage of a particular set of circumstances.
I think it's a golden window for China to release a stimulus package right now. The US Fed is very likely to cut interest rate in the next FOMC meeting. And if the Fed start to cut at least 25 basis points or maybe more, with a path of cutting the interest rate of 200 basis points, that effectively provides China a policy room to cut rates further.
But first, in 5 and 5 with ANZ, expectations are growing that the US Federal Reserve could kick off its rate-cutting cycle with a 50 basis point cut on Thursday. At the start of a big week for interest rates, with the Bank of England, the Bank of Japan, and central banks in Indonesia and Taiwan also set for rate reviews, market pricing for both a 25 and a 50 basis point cut from the US Federal Reserve is split at 50-50. Here's ANZ Head of G3 Economics, Brian Martin.
The reason why the market is pricing this in is because of reports in the media late last week that a 50 basis point rate cut was still on the table, and a growing argument that in order to underwrite the soft landing in economic activity, the FOMC probably needs to front-load rate cuts and get to neutral quicker.
The S&P 500 was trading flat at 4 a.m. Sydney, Melbourne time, while the yields on US Treasuries were down 2 basis points. The US dollar index was down 0.3% as those rate cut bets grew. The Aussie was up 0.57% at 67.42 US cents, while the Kiwi was up 0.5% at 61.88 US cents. Number 2. ANZ senior international economist Tom Kenny explains why he sees a 25 basis point cut as more likely than a 50 basis point cut.
Firstly, economic growth is looking okay at the moment. The Atlanta Fed GDP now suggests that growth in the third quarter is 2.5% annualised. Secondly, overall labour market conditions look okay to us. Significantly, we're not seeing any sort of notable lift in layoffs. Thirdly, equity markets are near record highs. And finally, in previous easing cycles, the Fed has only acted aggressively when there has been quite a disruptive financial event occurring and worries over an imminent recession are high. And we certainly don't have that now.
Number 3. Tom says one reason some are seeing a 50-point cut is that the so-called SARM rule has been triggered. This is where there tends to be a recession in the US whenever the unemployment rate rises by 50 basis points above its 12-month low. And it's just done that. Tom thinks, though, this time might be different.
One of the big reasons for the rise in the unemployment rate has been quite a strong growth in the labour force supply via higher participation rate and strong migration levels. Had labour supply grown at more normal levels, then the rise in the unemployment rate wouldn't have been nearly as much. We're expecting the growth in the labour supply to slow, and this should limit the size of any further increase in the unemployment rate. We will, of course, be watching layoff data very carefully.
Number 4. One big mover on currency markets in recent days has been the dollar yen. The yen strengthened again overnight to 139.58 yen to the dollar. That's the strongest it's been since July 2023. ANZ head of FX research Marja Ben Zaman says the US dollar is in a vice-like grip, with the Fed cutting on one side and the Bank of Japan tightening on the other.
Markets continue to point in at least one 50 basis points rate cut in 2024. So looking to see whether he reaffirms that or not. At the same time, on Friday, we've got the Bank of Japan meeting. We are not expecting a rate hike there. However, even the mildly hawkish commentary from Bank of Japan could be, again, yen supportive.
Number 5. One key data point ahead of the Fed's meeting is August retail sales tonight. Tom says some softness is expected, with a consensus for a month-on-month fall of 0.2%.
We don't necessarily think a soft core number for retail sales would influence Fed's policy decision this week. Broader consumer spending, which includes services, is reasonably solid at the moment. The Atlanta Fed estimates that consumer spending is contributing around 3 percentage points to GDP growth in the third quarter.
Tom Kenny there. Now, in our bonus deep dive interview, ANZ's chief economist for Greater China, Raymond Yeung, looks at the prospects for a 2 trillion yuan stimulus package. After weaker than expected economic data over the weekend, he sees the package, that's the equivalent of 281 billion US, starting with a cut in mortgage rates.
We know the mortgage rate in China is relatively high compared with other countries, and there might be an 80% basis point cut of the mortgage interest rate, and that will be very helpful to relieve the mortgage burden of households, because we know that the consumption of China has been very, very weak. So we believe that the government is going to help lift the household income level, and mortgage rate reduction is a very direct way to relieve the burden of urban household, and that would have some boost to consumption. Besides that, there also might be some tax cut, and also accommodated with some central bank's policy, monetary policy easing, and so on and so forth. So it's very likely to have a package of stimulus measures announced by the central authority.
So what might the scale of the package be, and how much of an impact might it have on growth this year and next?
From our point of view, we see that there is a growth gap of maybe 0.4 to 0.5% growth gap, because it is very unlikely if the government is just sitting on the sideline and don't do anything, that the growth will be very likely to come down to 4.5%, maybe 4.6%, but this is still may not be acceptable from the central government. Now, to try to reach 5% or maybe even 4.9% growth, then the total package has to be at least 2 trillion of renminbi, which means that we just use our understanding about the marginal propensity to consume, is an economic concept of how much income required to stimulus consumption, and seems that the 2 trillion renminbi can induce 700 billion of the GDP growth. Based on the growth gap, I think that a package of trillion is required, and if the government is really calculating and do their math, I believe that 1 trillion package will not be sufficient, and that will be 2 trillion. Maybe these measures will be spending across 12 months, but at least this will improve and lift the sentiment and close the growth gap between the official target and the actual growth momentum.
And how much propensity to spend is out there amongst consumers? Because one of the risks is that the government provides a tax cut and cuts mortgage rates, and then everyone says, right, I'm going to save that money, or I'm going to pay back my mortgage early.
Absolutely. I think this is a very important parameters in the whole estimation. So we just look at based on some of the very recent estimation by academics using micro level data, and a group of academics just estimate that a medium income urban household has the marginal propensity to consume, we call the MPC, at 35%, which means that if you get $100 saving, you're going to spend 35 on that. I think this is a very reasonable estimate, because right now, as this type of income level at the urban area with this cautiousness of spending, the MPC will not be very high. Unlike in the past, when there is an economic optimism, when the asset prices continue to go up, property price going up, and the marginal propensity to consume used to be very high.
And just finally, depending on the exact size and timing, what might any financial market implications be from a package of that size, 2 trillion?
It's a very good timing. I think it's a golden window for China to release a stimulus package right now. The US Fed is very likely to cut interest rate in the next FOMC meeting. And if the Fed start to cut at least 25 basis points or maybe more, with a path of cutting the interest rate of 200 basis points, that effectively provide China a policy room to cut rates further. And one of the reasons China could not cut interest rates, exchange rate concern, but right now we see that after the rate cut seems to be very confirmed from the US, then the renminbi exchange rate appreciate, and the central bank's PBOC does not really need to be so cautious in terms of interest rate cuts. So I think the timing is very, very good. Plus the fact that we are coming to the Mid-Autumn Festival. China is going to have a holiday, and if they are willing to announce some income boosting measure, maybe people going for domestic tourism willing to spend more money, that would be very helpful. And they may be buying a bigger box of mooncake to celebrate the holiday.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, September the 17th. Catch you tomorrow with the detail on US retail sales ahead of the big Fed decision on Thursday morning. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.